Hi guys, welcome back to Father and Son Investing. During the last video, I talked about 4 simple steps that you could use to go about picking your bonds or bond funds. At the end of that video, I mentioned that the next video I would do would talk about 2 bond funds that I'm particularly excited about, and that is TLT and EDV. The first one is the iShares 20 plus government bond fund, 20-year plus government bond fund. And the second one, EDV, is Vanguard's Extended Duration Bond ETF. I'm going to talk about these particular ETFs as an example. I'm not necessarily advocating that you pick only these 2, but as examples of what you should be looking at potentially for long-term government bond funds and why you might consider them now. So let's get started. Now, as a basis for this discussion, we need to cover a critical point about bond yields and prices and how those move when interest rates change. Many of you will already be aware of this, but some of you watching this video will not be. So for those of you who are aware of it, this is just a refresher, and for some of you, this is a very critical, important point that you need to understand when it comes to bond prices and bond yields. There is a critical relationship between these two. Now, just what is that type of relationship? This is called an inverse relationship, meaning that when bond yields fall, bond prices will rise, and vice versa. When bond yields rise, bond prices will fall. Now, why would that be the case? In order to understand this, let me just give you a quick scenario. If you had, say, a 5% bond, and the prevailing interest rates were to go down to 4%, you would have a lot of interest in your bond, which has a 5% interest rate or yield. So therefore, you would be able to charge someone a little bit more for that bond than what you paid for it, because they would be getting a yield that's a little bit higher, or a coupon payment that's a little bit higher than what the current interest rates would be. Likewise, if you had a bond that only was paying you 4% and interest rates went up to 5%, why would somebody want to buy your bond at 4%? You would have to give them a discount on the price in order to make that yield come up to the 5% yield that they could get on a current bond. So that's the way this looks. Just one more graphic way to look at this to send home this point. If interest rates decrease, then the bond price or the market value of your bond will increase. And if interest rates increase, the bond price or the market value of your bond will decrease. All right, now that we've covered that, let's talk about why there would be some interest in TLT and EDV right now. First, let's define what each of these are, TLT and then EDV. So TLT, that is the iShares 20 plus year Treasury Bond ETF. Important to know that this is an ETF. I think of the ticker symbol TLT as Treasury Long Term to help me remember this. As stated, this is an iShares ETF, and what you will find in here is strictly U.S. government bonds that are 20 years or more in maturity. I've gone ahead and scrolled down to the portfolio characteristics, and what you'll see is that they have only 45 U.S. government bonds here, and that the effective duration here is 16.59 years. I'm going to cover the importance of that here in just a second. I have gone ahead and scrolled down to the holdings just to give you an idea of the maturity date on these bonds. You'll see that the most recent one, or the one that will mature the soonest, is in November of 2042, and those go all the way out to 2051 if you were to take a thorough look at all of that. When we go to top issuers, you'll just see that the United States Treasury is 98.48% of the holdings within this. The rest of what you'll find in those holdings is essentially cash and cash derivatives. So the importance of that is that when it comes to the taxability of TLT, you're essentially looking at the same taxability as if you owned an individual U.S. government bond. Essentially, 98.5% of this TLT holding is not going to be subject to state and local tax, just like as if you had held an individual U.S. government bond or treasury bill or note. Now, I want to come back here and talk about this effective duration. What does this effective duration mean? And this is why TLT and EDV have some particular interest right now, just as the Fed is getting ready to lower interest rates in September. That is pretty much a given based on Chairman Powell's recent comments in Jackson Hole, Wyoming. The way that you can think about effective duration is pretty simple. Let's explain this. For for every 1% change in prevailing interest rates, you can expect the number of years here times that 1% change in terms of what your bond price will change. So for instance, interest rates currently set by the Fed are 5.25 to 5.5%. Should that drop to 4.25 to 4.5%, you could expect to see a 16.59% increase in the price of TLT ETF. Similarly, if rates went up to 6.25 to 6.5%, you could expect to see a 16.59% decrease in the price of TLT. Now, there are some important points to cover when it comes to long-term bond funds versus the Fed changing rates, short-term interest rates. We'll cover that at the end of this video. Next, let's go to EDV. All right, EDV is the ticker symbol here for Vanguard, Extended Duration Treasury ETF. I think of that ticker symbol as being Extended Duration Vanguard. This fund also exclusively holds long-term government bonds, and you'll see that the expense ratio is 0.06%. I neglected to show you the expense ratio for TLT. So let's quickly cover that. The expense ratio for TLT is 0.15%, or about 2.5 times that of EDV. The portfolio composition on this is 100% U.S. government bonds. So again, expect your tax situation to be similar as if you were holding an individual U.S. government bond. And if you want to see what the maturity looks like on these bonds, about 52% of it matures in 20 to 25 years, and about 48% matures over 25 years. Now let's go ahead and look at their effective duration on the Vanguard site. They call it average duration, but again, you would see that you'll see a similar change. In their case, they describe a situation where if the bond has a duration of 2 years, its price would fall by 2% when interest rates rose 1%. So that gives you that same definition that I was talking about. So in this case, their average duration is 24.1 years. So if interest rates were to fall by 1%, you could expect a 24.1% increase in the price of EDV. Similarly, interest rates rise by 1%, you can expect a 24.1% decrease in the price of EDV. Now let's just talk about why I think that there is some money to be made in TLT and EDV and similar long-term government bond funds. Well, let's just take a quick peek at how these have been doing over the last 5 days. You'll see that the price has been coming down over the last month. You'll actually see that the price has gone up a bit. However, what I really want to show you is what it has looked like over the last 5 years. Notice how much TLT was selling for back here in April of 2020, $165 per share. Then we'll see that the low came in right around October of last year at $83 per share. So if you had bought in October, you'd be up $13 per share right now. Now, the important point here is that this spike up from $83 up to right around $99 per share happened when people started getting very excited about the possibility of interest rate cuts in 2024, which have not actually happened yet, but are highly anticipated mid-September when the Fed next meets. Now, it may look as if the action has already been priced in, and quite honestly, for this first Fed rate cut, the action or the price has already really been priced in. But after the Fed cuts this first time, presumably in September, the anticipation is that they will continue to cut. The rate of those cuts, how often those cuts will take place, is not known yet. A lot of people tend to think that there will be at least 2 rate cuts this year. Some people are pricing in 4 rate cuts, which I think is excessive. Nevertheless, is it too late to buy TLT? Has the drop in interest rates already been priced in, and that's all we're going to see? I myself do not believe so. Looking back at what TLT was going for back when interest rates were next to nothing, $169 per share, I don't think we're going back to those days of interest rates being as low as they were prior to the pandemic. However, even if interest rates just come down 1% from where they are now, you're looking at, again, about a 16.5% increase in your price of TLT. If you buy EDV, you're looking at about a 24.1% increase in the price of EDV. So I'm looking at these not so much for what the bonds are yielding, although those bonds are yielding quite nicely now that they have been purchasing some more recent extended duration bonds. I'm looking at both of these, TLT and EDV, for capital gains potentially here, being able to increase the price of the bond with simply just a 1% change in the Fed interest rates. Now, I need to talk about this relationship of short-term Fed interest rate changes and long-term bond yields. Those don't always correlate, and in fact, we should expect to see that this inverted yield curve that we've had for so long will change. That's the difference between the 2-year yield, the 2-year Treasury note yield, and the 10-year Treasury note yield. I will tell you that there is an interesting article in Seeking Alpha saying that they believe it's time to sell long-term Treasury bonds, such as EDV. In this article, the author poses the question, but how can Treasury bonds go down, meaning the price of Treasury bonds, if the Fed is about to lower interest rates? He talks about the yield curve. We've seen this for a while now. This is totally not the way a normally functioning bond market yield curve should look. It should be looking just the opposite, with the 1-month Treasury bill having the lowest yield and the 30-year Treasury bond having the highest yield. The author of this article expects to see this yield curve start to flatten, which is how it would look here in orange. In order to do that, the yields on short-term Treasury bills would be coming down, while at some point the yields on the longer maturity U.S. Treasuries, the 10, 20, and 30-year, would start to go up. And again, if those yields go up, if the interest rates on those U.S. Treasuries go up, the price will come down. So potentially you could be looking at losing some money on TLT or EDV when that happens. The question will be, when will that happen? So as I see this is not necessarily a very long-term play to increase capital gains. This simply may be a year before we start to see yields rising on these longer dated U.S. Treasuries. It may be 2 years or 5 years. It's hard to predict exactly when that will happen, but I do believe at some point this will happen in the near future. Within the next 5 years is kind of my gut feeling. There are two factors that I see that are going to start to drive long-term interest rates up. The first has to do with the nation's fiscal health. This is an interesting report by the Government Accounting Office from February of this year. You may be well acquainted with this particular website, the usdebtclock.org. You'll note here that the U.S. national debt recently went over $35 trillion. $35 trillion, that's essentially about $100,000 per citizen here in the United States, assuming about 350 million citizens. Now, not only are we spending more and increasing our debt and deficit, but we're also increasing the interest payments that we're making on that debt. You'll see here that between 2021 and 2023, there was an 87% increase in the net spending on interest on the debt. And this is what the situation looks like projected out into the future in terms of percentages of GDP. What are the implications for this? Well, you can read about it in fine detail in the GAO report, but just essentially understand that as U.S. debt increases, there will be more and more financing of the debt, more and more Treasury bills, notes, and bonds that they need to sell, potentially with fewer buyers, knowing that there are other places in the world where people can start to invest their money, such as Japan increasing its interest rates while we would be decreasing our interest rates. All of that will lead to higher interest rates that the government will have to pay to get people to buy the debt. If the interest rates on U.S. government debt are up, that's going to increase interest rates for everything else that we buy, cars, houses, really everything, because even businesses will have to finance their debt at higher rates, which is going to lead to increase in prices. All right, that's factor number one, the U.S. government debt. But what else is starting to happen at the same time? There's an interesting article here from August 21 on wolfstreet.com talking about surging refis to speed up the Fed's QT. What's that about? First of all, QT stands for quantitative tightening. It's something that the Fed has been doing over the last few years to try to decrease the size of its balance sheet. A lot of that has been rolling off U.S. Treasuries. However, the Fed also holds mortgage-backed securities. And as those mortgages get refinanced, those mortgages will be paid off. Those mortgages that the Fed is holding will start to be paid off. And therefore, those will also be rolling off the Fed's balance sheet. This graph here is an example of just how fast this spike in refi requests has been happening. I anticipate that after the Fed lowers rates in September, we're going to see an even bigger spike in these refi requests. Therefore, more of these mortgage-backed securities that the Fed holds will be getting paid off. Now, this will be good for me because there is a stock that I've held for quite a while, which I have noticed has been surging recently, and that is Rocket, as in Rocket Mortgage. I've held on to that for years as it has just plummeted in price, but recently I've actually seen a gain in my Rocket shares, and I anticipate that after the Fed lowers their interest rates in September, I'm going to see a significant gain. I might be interested in selling it then because I'm really not that interested in holding Rocket Mortgage long term. If you're not familiar with quantitative tightening, there's a nice article that you can read here on Investopedia, but essentially know that quantitative tightening will be removing money from financial markets. When that happens, what happens to interest rates? Scrolling down again in this article just to answer the question, this removes money from the economy and leads to higher interest rates, looking at higher long-term interest rates. So these are two factors that I see will increase long-term government interest rates, or the yields that they're paying on their long-term debt, and therefore risks that EDV and TLT at some point the price will be going down. Again, how quick that will happen remains to be seen. Now, as we finish this video, I will just say that if that is a concern for you, one option would be to purchase a less long-term government bond fund, such as VGIT, which is Vanguard Intermediate Term Treasury ETF. Again, the expense ratio is nice and low at 0.04%. But if I scroll down here to the average duration, you'll see that it's 5 years, meaning that a 1% change in the interest rates would lead to a 5% change in the price of this VGIT, Vanguard Intermediate Term Treasury ETF. So that would be an option that you could consider because the price fluctuation would be much less if you're worried about losing potentially. All right, that's going to wrap this up for long-term government bond ETFs and some potential capital gains that I see that you can make, knowing that this is not going to be a 10 or 20 year play, but more like somewhere in the 1 to 5 years is my belief. Next video that we'll do in this series is going to be about corporate bonds. How do you go about finding corporate bonds? And is it better to buy an individual corporate bond versus buying a corporate bond ETF? Until next time, enjoy your investing.